Hello, today we're going to talk about an important concept in managerial accounting, cost, volume, profit analysis. In short, for CVP analysis. What is CVP analysis? It's quite easy. We need to figure out the cost and know the volume of our sales and to know the profits. Now, why it's important, for a company to survive and it gets better, it's important to make sure the company can earn enough profits. And normally speaking, we all understand if other things being equal, if the sale price is higher, usually the price goes up. If the sales volume goes up, you can sell more, the profit goes up as well. If the cost for making stuff gets lower, then the profit should get higher as well. And we know all these, but unfortunately, the real world is not as simple as that. Like we talked about, if your sales price is lower than your cost, the more products you sell, the more loss you have instead of more profits. And if you raise your price really high, we all know that the higher the price is, lower the sales volume will be because fewer people will be able to afford and wanting to buy, especially when they have other cheaper alternatives available to them. So higher the price, usually the sales volume goes down as well. It doesn't necessarily lead to increase in profit as well. So we need to figure out this. And when it comes to price, we know price is not totally an arbitrary of the companies because they need to look at the market, they need to look at what other people are charging to work out their rates. While price is not 100% in the hands of companies, companies do need to understand their cost and control their cost. That's what businesses can do, controlling their cost. The costs we have talked about so far, we can put them into direct material, direct labor, and overhead based on whether they can be pinpointed to each product. Or we can also classify them as variable expenses and fixed expenses based on whether the costs would vary as the number of cost drivers. Most of the time it's the output of the products, whether the output varies or not. If they stay the same, like rent, no matter how many you sell, then we call it fixed cost. If, for example, like a direct material, each plastic chair costs 2 pounds of plastic, then they sell 10 chairs, 20 pounds plastic has been used. So those are variable costs. So we need to understand all these to make a prediction about what a price point we have to set, and at a certain price point, based on the cost, the knowledge of cost, how many sales we can get, and what the profit will be, and whether there will be a profit or not, or we can see that whether what is the minimal amount of sales required for the companies to at least not lose money. So let's take a look. As I talked about, managerial accounting is nothing too difficult. It's a practical subject, like all the accounting classes, and then we can apply it to reality. And a lot of knowledge we knew already. The book just restated for us, and we need to have the confidence and take initiative to do it well. So what is profit? I guess everybody knows this already. Profit is total revenue subtracted by total costs. The difference between total revenue and the total costs are the profit for the business. So what is revenue? Sometimes people call it sales. If a business sells actual products, we know what the revenue is. For example, I have this cell phone here. Each cell phone costs, not a cost, each cell phone, the price is $1,000. So if they sell only one, the revenue is $1,000. If they sell 10, the revenue would be 10,000 bucks. So revenue is easy. It's just the price multiplied with the number of products sold. And the total cost, as we just explained, based on whether the cost component varies as the cost drivers, most of the time number of products varies or not, we can categorize them as total variable costs and fixed costs. Oh, here. Sorry, there was a typo there. So let's further decompose this. Let me ask, what is total variable costs? We explained already what are variable costs. Variable costs are the costs that as the number of products change, the cost will change, and in our book, changing at a constant rate. Like I said, 2 pounds of plastic for each chair, then 4 pounds for 2 chairs, 6 pounds for 3 chairs, 2,000 pounds for 1,000 chairs, right? 1 hour, 10 minutes for each, 10 minutes for each chair, then 2 chairs, 20 minutes labor hour, 100 chairs, 1,000 minutes for 100 chairs. So they vary with the number of products at a constant rate. And what is fixed cost? If to make chairs, somebody leaves a factory already, then and they pay 10,000, let's say, and then no matter how many chairs they sell, whether they sell at all or not, the lease will always be 7,000. What did I say? 10,000? 10,000 bucks, and it never change. So that is fixed cost. So based on what we learned, we know total variable costs can be decomposed as the multiplication of variable rate, which is a variable cost per unit of product sold, multiplied with number of units sold. So let's further decompose it. And I think I'm missing a right parenthesis, but I'll fix that later. So after decomposing, we know price, which is X. Sorry, we know the price multiplied with number of products sold. Subtract the sum of fixed cost and the multiplication of variable rates multiplied with number of products sold. And then let's do it again. We know that the difference between price and variable rate multiplied with number of products sold, subtract fixed costs, also equals to profits. And we have a fancy name for this. We call this first component of the equation formula, we call it contribution margin. It's total contribution margin. If you look at the difference between price and the variable rate, it's called a per unit contribution margin. So why we call it contribution margin, it's actually pretty vivid. If, for example, for the manpower and material for each product you make, it costs, let's say, $5, and you sell your product for $7, then each chair you sell, you make $2. That's we can measure for each chair. And the $2 from each chair, of course, depending on how many chairs you sell, has to be used for what? First, you have to use the total contribution margin to pay off fixed costs first. If you have rent, fixed costs, and fixed the rent only, you want to make sure you sell enough to at least pay off the rent, so you won't lose money. Then after that, everything from the contribution margin will be purely your profit. So we can see the way to measure profits gets clearer. Now let's still use the chair case, for example, as we talked about. For the chair, they use raw material and they have labor involved. On top of that, the company has utility and the place they use. So let's assume variable rate is $3 per chair, $2 from labor, $1 from plastic. So per chair variable rate is $3. And the fixed costs, the lease of the factory and the utility add up together to $25,000 per month, which is a lot. So if you look at this, right, what may affect profits? Price and sales volume, like we talked about, and here's a thing we saw already, right? So let's ask our first question. Given certain price, how many units has to be sold to break even for the company? What is break even? Meaning that the company is at the point there's no loss, there's no gain. So again, we try to play with this equation. What is breaking even again? No cost, no gain, which means profits equals to 0. And we don't know the price yet, but if there's a price, each price has $3 variable rate, and multiplied with shares sold, that's going to be the total contribution margin, and this has to equal to 25,000 for the company to break even. So we can see this as well, right? You have left side, which is 0, and on the right-hand side is the difference between price and 3, which is variable rate, multiply with shares sold, subtract 25,000 equals to 0, which means the contribution margin at break even has to equal to fixed cost. So let's add a hypothetical case. If the sales price, let's say, is $13 per share. So we can think, okay, for $13 per share, $3 will be used as $3 will be variable rate. So for each share, the per unit contribution margin will be $10. And how many shares do we have to sell to make up for the fixed cost first? So basically, they have to sell 2,500. 10, which is difference between 13 and 3. Okay, let's say the price is $13, right? 10, which is difference between the price 13 and the variable rate 3, multiplied with 2,500 will be exactly 25,000, which means the total contribution margin equals exactly to fixed cost, which allows break even. So we can do the same, right? So here's what we call operating leverage, which is an important concept. And why we say this, and it's, what is leverage? We heard this leverage term a lot, and we know what leverage looks like in real life. Basically, you move something on one end a little bit, and the thing on the other end will maybe swing a lot faster or slower. So here's what our contribution margin, here's our operating leverage is. Operating leverage, the higher it is, the more risky the company might be. Because we can all understand, right? The fixed cost won't change. Fixed cost won't change. So for a company with really high fixed cost, if their business goes bad, for example, if they sell for nothing, then not only they don't make any money, they have to pay all the high fixed costs. Meanwhile, if you look at another company with low or zero fixed cost, of course, they have higher variable cost, let's say, right? They have the same profit. However, it gives them much more flexibility. For each product they sell, the per unit contribution margin might be much lower, but in the worst scenario, when they don't do well, they don't have much fixed cost to pay and they can survive longer. However, if the economy is good and everything goes on perfectly, they can sell a lot, then a company with high operating leverage might be in a better shape, because for them, per unit variable rate is very low, and they can make all the money they want and only pay a fixed rate of fixed cost. So if you have any quick questions, please feel free to ask me. That's going to be it for the cost of volume profit analysis. Like I said, this is a very basic part of cost of volume profit analysis, but this is very fundamental, and you can use what we talked about here to study on your own.